rate and price in determinations of risk. Introduction to risk and volatility. Volatility means it's not a steady, stable. It's always be fluctuating. Risk refers to the possibility that actual returns will differ from expected returns due to uncertainty in financial markets. Volatile measurements the degree of variations in price or returns over time and is a key indicator of risk. In financial risk management, rate and price movement are the primary determinants of the risk. The essence of risk management is to help a firm to survive and grow. When the environment is unfavorable, the firm will concentrate on survival, and when it is favorable, it will attempt to exploit new growth opportunities. The speed with which a company adjusts to the environments depends crucially on the ability of its senior managers to observe and understand what is happening outside and respond accordingly. DGS has argued that strategic planning can accelerate the process of intentional learning provided its aim is not so much to draw up course of action as to change the mental models in the heads of people. When managers are encouraged to think of various possibilities, they can better absorb and digest information and most importantly, act as the environmental changes. This is especially valid during times of radical changes. As Clayton Christon of Harvard Business School puts it, the strategies and plans that managers formulate for confronting disruptive technological change, therefore, should be plans for learning and discovery rather than plans for execution. This is an important point to understand because managers who believe they know a market's future will plan and invest very differently from those who recognize the uncertainties of a developing market. Strategic planning in uncertain situations must take into account various risks. If the prevailing uncertainty is not properly considered, firm might end up facing threats it is ill-equipped to deal with. At the other extreme, the firm may show too much caution and not exploit opportunities that have the potential to yield excellent returns. Many companies take strategic decisions relying totally on their gut instincts during times of uncertainty. This is obviously a wrong thing to do. Intuition has to be backed with some numbers for strategic planning to be effective. Courtney, Kickland, and Vigri provided framework for strategic planning during condition of uncertainty. They refer to the uncertainty which still remains after a thorough analysis of all the variables in the environment has been done as residual uncertainty. In a simple situation, strategies can be made on the basis of a single forecast. As the next level of uncertainty, it makes sense to envision a few distinct scenarios. At an even higher level, several scenarios can be identified. In the most uncertain situations, it is difficult to even visualize scenarios, let alone predict the outcome. Where uncertainty is less, companies are typically more worried about their competitive positions within the industry. They take the industry structure as given and try to exploit the opportunities available and get ahead of rivals. Where uncertainty is high, firms have two broad strategic options. They can make heavy investment and attempt to control the direction of the market. Alternatively, they can make incremental investments and wait till the environment becomes less uncertain before committing themselves to a strategy. You may have know about shares and ownership of the company. If anyone have more than 51% shares of the company, then he is the owner of that institutions or organizations. Okay, so company always try to sell only 49% of sell. Okay, because investor are there to invest their money, because people have a lot of amount to invest. They are searching. Few people also invested their money in cooperative societies, but that societies were not secured. You have to pay or you have to save your investments only in banks or nationalized banks. Okay, because there is a control of RBI. Bank also have a facility to take insurance of investments to secure investments of the customers or shareholders, because government give facility that if any bank or a financial company goes into liquidations, what will happen? The insurance company will pay the investment amount with interest or with the maturity amount. So always keep in your mind, few students have submitted their title about research and they are doing a research on cooperative societies, but you are not allowed to do research on cooperative societies. That is also called as Patasamstha or Patpedi, because you are an MBA student and you must have to do research in cooperative bank, corporate bank, government bank, or financial institutions. Your vision should be broad level and not small. Okay, so keep into your mind that you must have to do research only on top level management and not on low level management. In the intervening period, the firm can collect more information or form strategic alliance to share risk. In short, a firm has to arrive at an optimum portfolio of investments: heavy risky investments, small risky investments, and heavy, not very risky investments. The mix would depend on the degree of uncertainty in the environment. Discovery driven planning as a risk mitigation tool. In highly uncertain situations, conventional planning methods may not be appropriate. Rita Gunther, McGrath, and Lan C. Macmillan suggest the use of discovery driven planning in this situation. In uncertain ventures, many assumptions are usually made so as the project progresses. There is a compelling need to incorporate new data and revise these assumptions on an ongoing basis. Take the case of Euro Disney. A key assumptions made before the execution of the project was that 50% of the revenues would come from admissions and the remaining 50% from hotels, food, and merchandise. After the project was completed, Disney found that tickets prices were less than anticipated and that visitors did not spend as much as expected. So, in spite of reaching a target of 11 million admissions, profitability remained below expectations. Ticket prices had to be lowered due to the recession in Europe. Disney had expected people to stay in the hotel for 4 days, but people spent 2 days on an average. Since there were only 15 rides compared to 45 at Disney World in the US, Disney had assumed that there would be a steady stream as in the US and Japan, but the crowds came in only during lunchtime. Disney's inability to seat all of them led to loss of revenue, dissatisfied customers, and bad word of mouth publicity. Visitor to Euro Disney also purchased a much smaller proportion of high margin items such as t-shirts and hats than expected. Few hotels are giving different types of offers or attractions to the customers that when in a down season they give less rate waste with best food free of cost or with 50% discount. Okay, because every hotel institutions want to accommodate their rooms as well as their food because they have to pay regular expenses of all the staff members, electricity, and all the expenses. You may know about if you want to book a ticket of a movie, how will you book the ticket? You must have to use two apps for that. You will use a district app or book my show. Okay, these are the famous uh, apps to booking a movie show online from your home. And in this way, the company are taking too much benefit, crores of business at only a one end. They have invested only one time to develop that app. Okay, and they are making profit from each customer near about 20 to 50 rupees as per city. Okay, in a day, minimum lakhs of tickets are booking done. So they are, you can calculate that how much amount that they are earning for a show, only a show. And there were near about 4 to 6 shows are available. Few movie theaters start shows from 12 noon and few movie also start movies from 9 a.m. early in the morning. Now summarize the mistakes made by companies. While planning new projects with a great degree of uncertainty, company do not have precise information, but after a few important decisions are made, proceed as through the assumption are facts. Companies have enough hard data but do not spend adequate time in checking the assumptions made. Companies have enough data to justify entry into a new business or market, but make inappropriate assumptions about their ability to execute the plans. Companies have the right data and may make the right assumptions to start with, but fail to notice until it is too late that a key variable in the environment has changed. The discovery driven planning approach prescribed the use of four different documents which are updated as events unfold. First, a reverse income statement to capture the basic economic of the businesses. This statement starts with the required profit and works backwards to arrive a revenues and cost. Pro forma operations specifications that specify the activities associated with the business, including production, sales, delivery, and service. This was second. And third, a checklist for ensuring that all assumptions are examined and discussed not only before the project starts, but even as it is executed. Fourth, a planning chart which specifies the assumptions to be tested at each project milestone. This allows major resources commitments to be postponed until evidence from the previous milestone event signals that the risk associated with the next step is justified. They have pointed out some of the fault implicit assumptions made by companies. First, customer will buy the product because the company think it's a good product. Second, customers run no risk in buying from the company instead of continuing to buy from their past suppliers. In gold showroom, when you visit to a gold showroom to purchase gold, there is a best policy of that salesman when you have finished your purchasing. Okay, what he says that you are lucky that you buy this gold before few times because rates are extended. Okay, so he always use these words means you will be happy to get profit. Okay, means you will get the gold on less price. And same situations happens in the hospital. Like when you admit a patient in the hospital, what doctor says? Doctor says that you are lucky person that you have admitted your patient before emergency. If you let your patient only 5 minutes, there may be a tragedy. You can lose your patient. This is the marketing policy. Okay, the product can be developed on time and within the time. Fourth, the product will sell itself. Fifth, competitors will respond nationally. Six, the product can be insulated from competition. Many of these assumptions do not turn, but to be valid as the project evolves if organizations is not taken of this. There could be serious problem at a later data. Utility to conventional appraisal techniques where uncertainty is high. Conventional appraisal techniques such as net present value (NPV) are of little use. According to David Sharp, NPV's effectiveness for investment appraisal is limited. The present value of an investment's cash flow excludes the valuable options embedded within the investments. These options gives the company the ability to take advantages of certain opportunities later. For project with long-term strategic consequences, the options are frequently the most valuable part of the investment. Since NPV calculations understate value, a selection process driven by NPV will reject more potential profitable projects. In other words, when evaluating projects with a very high degree of uncertainty, companies may not take a risk worth taking due to the use of conservative appraisal techniques. Uncertainty, ultimately, the objective of risk management is to facilitate value adding investments. In the real world, the demand for a product and the price which it can command in the market are uncertain. So, there is considerable uncertainty about the cash flows which will be generated. How do we decide which project is the right one? Like Sharp Martha, Amram, and Nalin Kultiliga suggest the use of real options while evaluating a project. Thus, the timing options in the front of the delayed expansion in capacity could create value in a situation of uncertain demand. Putting up a plant in an overseas market currently fed by exports may generate new growth options, but in export market, the volatility is very high and exit options in the form of a plant closure increases the value of the investment decisions by looking at strategic decisions in terms of options and then using information from financial markets to value these options. Risk can be greatly reduced. Oil companies, for example, can predict the future price of oil through the future markets. Decision makers will not be able to draw information from the financial markets. For all decisions, some decisions typically involve uncertainties which are insulated from the market mechanism and are specific to a company. Amran and Kultilaka call these private risk, but as more and more risk becomes securitized, the options approach may become more and more visible. Amran and Kulatilaka argue that traditional valuation tools, which view business development in terms of a fixed path, are of little use in an uncertain environment. In the real world, a new business or a major investment in capacity expansions may result in a variety of outcomes that may demand a range of strategic responses. Plans to change operating or investment decision later, depending on the actual outcome, must form an integral components of the projections. Thinking of the investment in terms of options allows uncertainty to be taken into account. As Amram and Kultalika put it, the real value of real options, we believe, lies not in the output of black holes or other formulas, but in the reshaping of executives thinking about strategic investment. By providing objective insights into the uncertainty present in all markets, the real option approach enables executives to think more clearly and more realistically about complex and risky strategies decision. It brings strategy and shareholders value into harmony. In any investment appraisal process, managers should identify the embedded options, evaluate the conditions under which they may be exercised, and finally judge whether the aggregate value of the options compensates for any shortfall in the present value of the project's cash flows. However, as Shar put it, options are of value only in an uncertain environment. Thus, investment decisions whose primary objective is to acquire options must be made before uncertainties in the environmental of resolved. Sharp says, unlike cash flows, whose value may be positive or negative, option values can be never be less than zero because they can always be abandoned. Embedded options can therefore only add to the value of an investment. Options are only valuable under uncertainty if the future is predictable. They are worthless. Scenario plannings from the time immemorial, man has had to prepare himself for various eventualities just to survive. He has had to ask questions like, what if it snows? What is there a poor harvest? Indeed, it is this type of thinking which made man think of taking various steps such as storing food, building dams, etc. In corona period or pandemic, only Indian people can survive because the policy of Indians are very best about to save money, and every woman always save money from the income of their husband or head of the family. So this amount helped Indians to survive or sustain in the period of pandemic because in abroad so many peoples attempted suicide because they don't had money for survival, and money is the important part to survive. Even Indian government also helped people to deliver or to provide grocery items totally free of cost from ration shop. Determinants of value. Firm's value maximization and the cost of risk. As we noted in these sessions, a business value to shareholders depends fundamentally on the expected magnitude, timing, and risk variability associated with future net cash flows, cash inflows minus cash outflows that will be available to provide shareholders with a return on their investment. Business value and the effects of the risk on value reflects an Ex ante perspective. Value depends on expected future net cash flows and risk associated with these cash flows. Cash inflow primarily result from sales of goods and services. Cash outflows primarily arise from the production of goods and services. For example, wages and salaries, the cost of raw materials, in interest on borrowed funds, and liability losses. Increases in the expected size of net cash flows increase business value. Decreases in expected net cash flows reduce value. The timing of cash flow affects value because a dollar received today is worth more than a dollar received in the future, because most investors are risk averse. The risk of cash flows reduces the price that they are willing to pay for the firm stock, and thus its value, provided that this risk cannot be eliminated by investors holding a diversified portfolio of investment, which we discuss in more detail in these sessions. For a given level of expected net cash flows, this reduction in the firm stock price due to risk increases the expected returns from buying the stock. In other words, the variation in the net cash flows causes investors to pay less for the rights to future cash flows, which increases the expected returns on the amount that they invest. Thus, a fundamental principle of a business valuation is that risk reduces value and increases the expected returns required by investors. The actual returns to investors in any given period will depend on realizations of net cash flows during the period and new information about the expected future net cash flows and risk. Before to talk forward, I'll again like to request you that you must have to join tomorrow's financial workshop in our matrix college. So all student must have to be present in the college. Okay, and you have to do all the your pending works within a day. Okay, it is a full day workshop. So if you are on the job, take full day leave from your company. The notice already given to you in your emails, in your mobiles, and phone calls also done by the teachers. Okay, so you must have to present. Maximizing value by minimizing the cost of risk. Unexpected increases in losses that are not offset by cash inflows from insurance contract, hedging arrangements, or other contractual risk transfer increase cash outflows and often reduce cash inflows, thus reducing the value of a firm stock. The effects of risk and risk management on firm value before losses are known reflect their influence on the expected value of the net cash flow and the compensation required by shareholders to bear risk. Much of basic financial theory deals with the kind of risk for which investor demand compensation and the amount of compensation required. We will have more to say about how risk affects expected cash flows, risk and required compensations in later session. For now, it is sufficient for you to understand that making risk management decisions to maximize business value requires as understanding of how risk and risk management methods affects one expected net cash flows and second the compensation for risk that is required by shareholders. If the firm's cost of risk is defined to include all risk related costs from the perspective of shareholders. A business can maximize its value to shareholders by minimizing the cost of risk. Cost of risk equal to value without risk minus value with risk. This is a formula. Writing this expression in terms of the firm's value to shareholders in the presence of risk gives value with risk equal to value without risk minus cost of risk. What is the formula? Two formula is given. Cost of risk equal to value without risk minus value with risk, and value with risk equal to value without risk minus cost of risk. The value of the firm without risk is hypothetical and abstract concept that is nonetheless very useful. It equals the hypothetical value of the business in a world in which uncertainty associated with net cash flows could be eliminated at zero cost. This hypothetical value reflects the magnitude and timing of future net cash flows that would occur without risk and risk related costs. We emphasize that this value is entirely hypothetical because risk is inherent in real world business activities. To illustrate the cost of risk, considered the product liability example introduced earlier for the pharmaceutical company. The value of the firm without risk is the hypothetical value that would arise if 1. It were impossible for the drug to hurt consumers and thus produce lawsuits, and second, the firm did not have to incur any cost to achieve the states of riskless bliss. The reality of injury risk and the cost of loss control give risk to risk related cost, thus reducing the value of the business. In pandemic, pharmaceutical companies were on the boom positions. They have earned more than the expected amount. In pandemic, first or in initial stage, few doctors are taken holidays instead of to check the patients. But later on, they understood that pandemic is an opportunity to them to earn more money, and say so they have started their practices. Okay, and you know India has developed a best medicine or dosage to survive from pandemic attacks, corona attacks, and India also helped other countries and provided that dosage without any cost or without any money, totally free of cost. And so the respect of India is increased in the minds of other countries' people. Equation 2.2 implies that if the firm seeks to maximize value, it can do so by minimizing the cost of risk. It accomplishes this by making the reduction in value due to risk as small as possible. Thus, as long as costs are defined to include all the effects on value of risk and risk management, minimizing the cost of risk is the same thing as maximizing value. Why bother introducing the cost of risk instead of just taking about value maximizations? First, the cost of risk concept helps focus attention on and facilitates categorizations of the major ways that risk reduces value. Second, the concept is used extensively in practice, although its breadth is sometimes narrower, as is noticed below. Measuring the cost of risk. In order to maximize business value by minimizing the cost of risk, businesses ideally will estimate the size of the various components of the cost of risk and consider how this cost will be affected by the firm's operating and risk management decisions. However, in practice, the necessary analysis is costly. Moreover, some of the components are particularly difficult to measure. Example include the estimated cost of foregone activities. For example, profit that would have been achieved but for risk and the reduction in activity, the impact of decision on customer or suppliers, and the cost of residual uncertainties. As a result of these practical limitations, business often will not attempt to quantify all of their cost precisely. Small businesses especially are unlikely to measure cost with much precision because the cost of analysis is usually large compared to the potential benefit in the form of improved decisions. However, even when quantified, the various components of the cost of risk is not cost effective. Managers need to understand these components and the general ways in which their magnitude will be affected by the risk management. This understanding is necessary for making informed decisions using intuitive and subjective assessment of the effects of decision on cost. Subsidiary goals. While the overall objective of risk management is to maximize business value to shareholders by minimizing the cost of risk, a variety of subsidiary goals is used to guide day-to-day decision making. Example of these subsidiaries goals include making insurance decisions to keep the realized cost of uninsured losses below a specified percent of revenues, purchasing insurance against any loss that could be large enough to seriously disrupt operations, making decisions to comply with stipulations in loan contracts on the types and amounts of insurance that must be purchased and spending money on loss control when the savings on insurance premiums are sufficient to outweigh the cost. These types of rules generally can be viewed as the means to an end, that is, as practical guides to increasing business value. However, in each case, there should be a reasonably clear link between the particular goal and the increase in value. Objective for non-profit firms. How does the overall objective of risk management differ for non-profit or government entities that do not have shareholders? Non-profit firms can be viewed as attempting to maximize the value of products or services provided to various customers and constituents. For example, taxpayers or persons that donate money to finance the firm's operations, where value depends on the preference of these parties. If the cost of risk is defined as the reduction in value of the non-profit firm's activities due to risk, the appropriate goal of risk management remains minimization of the cost of risk to those constituents. In corona pandemic, a few non-profit organizations and few private organizations also helped people for survival. This is found in only India. These types of cooperations to build best society. Minimizing the cost of risk for non-profit firm may involve giving greater weight to certain factors than would be true for a for-profit firm. A non-profit hospital, for example, might place greater emphasis on the adverse effects of large losses on its customers than would be a for-profit firm. In Mumbai, Tata company built a hospital, cancer hospital, for the patient of cancer disease, totally free of cost. And other industries also providing funds to these types of hospitals, which is built under a trust, means a charity. It's a charity organizations. However, while the details may differ, the overall objective of risk management and the key decisions that must be made by non-profit firms are similar to those for-profit firms. Non-profit firms need to identify how risk reduces the net value of services provided and make decisions with the goal of minimizing the cost of risk. They have to consider the same basic components of the cost of risk as for profit firms. It is not clear whether the absence of shareholders and the possibly fewer penalties for failing to minimize cost make agency cost greater for non-profit firms than for-profit firms, or if so, whether this affects risk management. A question arises that will manager maximize value? Because it is totally depend upon the policy of the manager or CEO to produce the inside the shareholders. Now let's see owner managers, for example, sole proprietors, managing partners, and owner managers of corporations without publicity traded common stock have a clear incentives to operate their businesses to achieve their own interest. This generally will involve value maximizations, provided that value is appropriately defined to reflect the owner's attitude toward risk and their ability to deliver, diversify their risk of ownership. One of the longest and most thoroughly debated subject in business economics and finance is whether managers of large corporations with widely held common stock, that is with large number of shareholders that are not involved in management, will diligently strive to maximize value of shareholders. The ownership and management functions are separated in business with widely held common stock. Managers can be viewed as agents of shareholders. Means managers are mediators of shareholders and the organizations. Managers may have incentives to take actions that benefit themselves at a cost to shareholders, thus failing to maximize shareholder wealth. The cost associated with these actions, including the cost incurred by shareholders in monitoring manager behavior, are broadly referred to as agent cost. Relationship between risk and volatility. Higher volatility implies higher uncertainty and risk. Volatility is commonly measured using statistical tools such as variance and standard deviations. There is a software also, that is SPSS software, that you have to use for your research. It's a statistical package for your social science research. Risk is not just loss, but variability in returns. Role of price in determinations of risk. We have already seen price risk arises from fluctuation in the market price of financial asset such as shares, bonds, commodities, and derivatives. Sources include market demand and supply, economic conditions, political events, corporate performance, and speculative activities. Measurement of price risk. Absolute price change equal to this formula is given, which will be provided to you later on. Price a return holding period return, variances, and standard deviations. Square root of variance, most widely used measures of price volatility. Role of rate in determination of risk. Rate represent percentage changes and are more reliable than absolute prices. Types of rates affecting risk. Interest rate risk, risk arising from changes in interest rates, affects bond prices. Inversely, longer maturity bonds have higher interest rate risk. Second is rate of return risk, variability in expected returns, and other is highly variability equal to higher risk. For role of rate in determinants of risk, types of rate affecting risk. 3. Exchange rate reliefs, risk due to fluctuations in foreign currency rates, affects firm involved in international trade and investments. 4. Discount rate risk, changes in discount rates affects the present value of future cash flows. 5. Rate of return as a measure of risk. Expected rate of return formula is given of probability of outcome and rate of return. Risk measurement using rate of return, variability of returns around the expected returns indicate risk, and standard deviation of returns is commonly used. 6. Volatility measurement techniques. First, historical volatility based on past price or return data calculated using standard deviations. Second, implied volatility derived from option prices reflects market expectation of future volatility. 3. Beta systematic risk formula is given, measures sensitivity of asset returns to market movements. Prices versus rate in risk measurement. Basic, price and rate. Nature, absolute value, relative value. Measurement, price changes, percentage changes. Comparability, limited and high. Risk assessment, price less accurate and rate more accurate. Usage, price short-term analysis and rate long-term and portfolio analysis. Importance of measuring risk helps investor assess investment uncertainty, aids portfolio diversification, supports financial decision making, essential for derivative pricing, helps regulators and financial institutions manage exposure. Limitation of risk and volatility measurements based on historical data does not capture extreme or rare events, assumes normal distribution of returns, ignores behavioral factors, and conclusion. Risk and volatility measurements are central to financial risk management. Price show absolute changes, while rates provide standardized measures of risk. And last, effective analysis requires considering both price and rate movement. Thank you. The session is over.